Hello, everyone. Welcome to Fastmarkets complimentary webinar for flat steel, and thank you very much for joining us today. For those of you who don't know me, I'm Julia Bolotova. I'm a senior steel price reporter at Fastmarkets, covering flat steel markets in Europe. And today, me and my colleague Paolo Frediani from the research team are going to talk about the key trends and the most recent developments in the European flat steel market. And we'll also try and make an outlook, a forecast to see what lies for us in 2024. It's a quite volatile market, quite complicated market, so making all kinds of outlooks is kind of complicated, but our research teams is exceptionally good at doing this. So hopefully we all will have some very useful and interesting insights. So it's already 11:02. I think we wait a couple more minutes and then kick off. We will start with a methodology overview. After that, I will talk about spot market developments for our key flat steel products, and then hand over to Paolo, and he will do the forward-looking statements and outlooks for the market. After that, we will have a Q&A session. You will have a chance to type your question in the Q&A tab. We will have about 10 to 15 minutes for that. And also during the course of the presentation, we will have a couple of polls just to reflect on the most interesting, most hot topics in the market and ask your opinion about that. So I think we shall start now. For those who will join us later, we will have a recording. So yeah, let's start with the methodology overview. The next one, please. Here, for those of us who are not familiar with Fastmarkets, we are a price reporting agency with a quite rich history, has been publishing price reference for the metals industry since 1882. But over the course of the last few years, we've really invested a lot in to rebrand as a professional self-regulated PRA. In 2015, we've established our own database called Mind, which helps to align our pricing to the IOSCO principles for PRAs. All our key prices and benchmarks are aligned with IOSCO principles, and over 20 of our key benchmarks and prices have type 1 or 2 certification. On the next slide, you can see the very quick overview of our methodology styles. So we have two major methodology styles: assessment and index. Assessment is usually a range expressed at high and low. It is usually suited for more for less liquid, low maturity markets, and majority of Fastmarkets prices outside of more liquid markets are usually sit in this category. The second one would be index, which is single figure, volume weighted average. And we usually use it for more mature and liquid markets. And of course, here key examples would be raw materials such as iron ore, scrap, manganese ore, coking coal, and of course, our benchmark hot rolled coil indices in Europe. And on the next slide, I would like to do a very quick overview of our pricing process. So we have highly skilled, trained price reporters for specific markets in 13 global locations. They collect market data, and the goal is to collect as much as possible from buy and sell side of the market. Then Stage 3 and 4 vary slightly depending on whether the price is an assessment or an index. Index follow formula, and outliers are automatically discarded, but editorial judgment applies to the both methodology styles, and all our prices need to be justified with a price rationale. Once prices are entered in our database, we have 3 pair of eyes to look at them before they go live. So we have a price reporter who have collected the price, another price reporter who is peer reviewing it, who is well familiar with the market, and finally senior reporter who is publishing prices in our price book dashboard, on a dashboard. Next one, please. Here, a very quick overview of our key HRC index, because I'm going to talk a lot about hot rolled coil today, and so will my colleague. So HRC index consists of 2 sub-indices, buy side and sell side. And for each sub-indices, we make sure not a single data submitter accounts for more than 50% of the information. Outliers, which are more than 10% away from the mean price, are automatically discarded, and we always hold the right to use editorial judgments and discard some questionable price points. But of course, all this will be explained in the rationale. Next one, please. This would be it. Very quick overview of our methodology. And now let's get to the interesting part. Why are we here today? To talk about flat steel market. So let's take a look at this slide, and you can see quite a roller coaster here for global HRC prices in the past year. Maybe ups and downs were not as sharp as in the previous year, triggered by Russia's invasion in Ukraine, but still we see that market remains volatile. And on the next slide, I would like to take a closer look at our favorite European market. You see quite consistent rise with curves are moving up for domestic and for import prices as well for HRC. But was this increase actually triggered by better demand? Not so much, unfortunately. These increases in the Q1 and most of Q2 2023 were a result of reduced capacities. At the end of 2022, most of the European steelmakers have been, well, not most of them, but a lot of them were taking offline blast furnaces to bring supply in line with a very subdued demand. And as a result, in the first quarter, when people felt the need to restock, the supply actually fell short of apparent demand. And also we had a couple of black swans during the second quarter, such as fires at ArcelorMittal in Spain and France, and consequently force majeure and lost production. Force majeure Tata Steel for mainly affecting downstream products. However, I would say by May, June 2023, the market was more or less calibrated, and most of the idle capacities were brought back online, and increased availability together with still limited end user demand and increasing gap with imports put pressure on the domestic prices in Europe, and we see them starting sliding down. And they've been sliding down until very recently, and only, I would say, in the end of October, beginning of November, European producers have started to push for higher prices. There was a consolidated push, but once again, the increases achieved are not demand-driven. They are driven by some apparent steel demands, some restocking, and also the fact that all these announcements were preceded by another idled capacities. So on the next slide, you can see pretty similar picture for downstream products, and for cold rolled and for hot dip galvanized. For cold rolled, we also see import pressure being quite strong until very recently, when overseas suppliers also started to increase prices, and the lowest options below 700 euros CFR were gone from the market. I would like to take a bit of a closer look at the capacity situation in the next slide, what drives all these increases. So here you can see the key European steelmakers and what they're doing with their capacities. During the end of Q3, beginning of Q4, we saw quite a lot of stoppages, and what worries the market right now with the acute uptrend we see. They call it buyers call it quite fragile, because during Q1 we expect at least 2, maybe 3 blast furnaces coming back online, therefore increased availability again. And here I'm talking about Salzgitter restarting blast furnace A, and also we expect blast furnace in IJmuiden and Tata Steel to come online relatively shortly. They are in delay, I guess, were supposed to restart in November. And ArcelorMittal, while commenting us on the restart of Fos-sur-Mer blast furnace, said they will consider a restart during Q1 if demand allows it. So the market remains quite complicated, quite volatile. And at the next slide, I would like to take a look at another challenge. This map is a little bit more cheerful. It's all in green, as you can see. And as opposed to the previous map, when we had idled capacities, this one shows us the capacities that are expected to come online as of 2025, 2026. And yes, in line with European Union ambitious targets to be carbon neutral by 2050, European steelmakers are gradually reshaping their existing steelmaking route. And basically the idea is to move from a basic oxygen furnace plus blast furnace route to EAF plus DRI models. Most of the capacities that you can see on the map are expected to go live 2025, 2026 onwards. I understand to be in line with also CBAM phasing in full steam. And the next slide, I would like to take a look, at the key steel makers here. All of them have their own brands of green steel, carbon reduced steel, whatever you name it. And also here it's a poll time we were talking about. We would like to ask your opinion on whether the green steel demand would increase in 2024. Please choose your option and vote, and we will talk about the results during our Q&A session. So here is, you can see major producers are actually sealing contracts with end users, mainly in the automotive industry, and to supply these green steel tonnages from the new capacities. And we can see that sustainability is much more noticeable on the agenda of end users recently. And by end users, I mainly mean automakers and some companies in the construction. So of course they do expect the demand for green steel to increase gradually, and maybe the green steel will be short in supply in the upcoming years as demand increases, and they want to be first in line to get these tonnages. And on the next slide, you can see that, Fastmarkets as a leading PRA also wanted to be the first and to track all these changes in the market. That's why we launched our very first green steel suite of prices in June this year. So basically, the first price you can see here would be the green steel premium for our flat rolled HRC prices. It is published weekly. We accept price points for the steel, electrically produced steel with scope 1, 2, and 3 emissions of maximum of 1 ton of CO2 per ton of steel. We understand that's quite a generous threshold, but at the same time, it's very young, very evolving market with a very patchy demand, and that way we wanted to catch as many liquidity as we can. The second one would be a daily inferred price, which is calculated by adding weekly green steel differential to the daily Northern European index. And on the next slide, you can see how it has been evolving since June. So at all times, the premium was over 25%, sometimes 30% plus. So that kind of shows us that, yes, green steel premiums are being paid in the market, but are they being paid by everyone? Not so much. Once again, as we can see, end users in the automotive industry are the main drivers for these demands. But we expect that to change gradually during the course of the year. And at the next slide, please, I would like to take a closer look at what is driving these changes. Of course, CBAM, carbon border adjustment mechanism that is set to ensure equal level playing field for the European mills and for overseas goods suppliers to ensure that imported goods have the same carbon footprint for similar goods produced outside the European Union. And yeah, the transitional phase for CBAM has just started on October 1st, and it will continue until December 31st, 2025. And during that transitional phase, any financial adjustment would not needed to be paid. The only goal is to collect information about emissions and yeah, to basically make sure that this information is consistent, that is up to date. However, we are aware that during the transitional phase, the quality of information received might not be the best, because it is a challenge for the global market, for the entire market, because it's tied, linked very tightly to the emission trading system, and that system is unique to the European Union. Hopefully by 2025, the Commission will come up with a more unified approach, how the emissions are going to be submitted, and we expect a whole bunch of the new entities to appear in the European Union to verify CBAM declarations. Now let's take a bit of a closer look at imports, because imports continues to play a very important role in Europe, and during the course of the past 3 years, it has faced great changes. First of all, Russia's war in Ukraine has changed the map and reshuffled trade flows. Russia was gone from the map because it was sanctioned in the European Union, and Ukraine struggles with the logistics, which is completely understandable. Our ports continue to be blocked and bombed by Russia, so deliveries are quite a challenge. At the same time, Asian suppliers have kind of stepped up and their presence has increased in the market. And please note that for 2023, data for only 9 months are available, but even so, some suppliers like Vietnam, Egypt, South Korea, Taiwan already in 9 months managed to exceed their deliveries as compared to the full 2022. And at the next slide, we can see that, yeah, the quotas, safeguard quotas in the previous year were filled at relatively slow pace. You can see only a couple of figures in red here. But in 2023, on the next slide, you can see that situation has changed gradually, and well, a lot of countries are in red here. For other countries, I use import information from Japan, Vietnam, Egypt, and Taiwan as a key suppliers under other countries categories. For Q4, actual import is not fully available, but we all remember October the 1st when we checked the quotas on the Commission website, and it was gone for other countries in about a day or two. And not all volumes were actually custom cleared, and that's why we expect Q1 and Q2, maybe even Q2 quotas for 2024 will be filled very swiftly. The next one, please. Yeah, still safeguard measures, of course, it has been not really came as a surprise that it has been extended for 1 more year. But yeah, Very minor changes were applied. You can see it were mainly the adjustments. They extended for 1 more year until June 30, 2024. And now I also would like you to vote in another poll. And we would like to ask your opinion about import flows into the European Union and check if you think that import from Asia will grow further in 2024 based on what we've already discussed during the previous slides. Yeah, so basically still safeguards were not supposed to be extended for 1 more year, and Commission kind of created a precedent, and we do expect them to remain in place until CBAM fully phases in to basically replace it. So yeah, the next slide, please. Here, I would like just you to take a look at the existing trade measures for flat steel products in the European Union, and you can see that Europe is indeed a fortress, and import is a challenge for those who are dealing with it. We have CBAM, we have safeguards, we have anti-dumping, and recently for the number of products, the anti-dumping cases have been extended for 5 more years. And of course, speaking about trade limitations, I cannot help mentioning sanctions. On the next slide, I would like to pay attention that yes, Russian finished steel products to the European Union have been banned, but for semis such as billet and slab, on this slide you can see have been granted quite generous quotas in the volumes of historical imports, and quotas valid until September 30th, 2024. And you can see that import is quite active. European buyers continue booking Russian slab, and it's kind of understandable also because Ukraine and Russia were the key suppliers of steel slab to the Union. However, after Russia has destroyed our steelmaking capacities in Mariupol, Ukraine was out of the game, and yeah, rollers kind of lobbied the quotas for a slab. And right now, around the end of the third quarter, beginning of Q4, the rumors have started to circulate around the market that rollers in the European Union prepared to lobby another extent of quotas for Russian slab beyond 2024. Nothing has been set in stone, nothing has been confirmed, but it is very likely that we might see that quota extension, because once again the lobby is quite strong, and we see that particular Russian companies have a strong presence in the Europe with steelmaking capacities and partially owned by governments in Benelux region. And just to wrap up, because I want to be conscious of time, what can we expect for 2024? HRC prices would most likely to remain high in Q1 2024, based on what we see in terms of order books for European mills and reduced supply. Other countries' quotas is very likely to be taken swiftly for Q1 and maybe even for Q2 2024. And at the same time, we cannot expect that end-user demand to rebound to pre-COVID levels, not only in the first half of the next year, but maybe even in the second half. And here I would like to hand over to Paolo, and he will talk with you about our expectations for 2024. Thank you. Paolo, please.
So good morning, everybody. Thank you for being here. Yes, as Julia said, I will provide an outlook for 2024 for the coil product market. But first, let me spend just 1 minute talking about what we do here in the research team. You are all familiar with Fastmarkets price assessment. You are all familiar with Fastmarkets news, but Fastmarkets also forecast prices, specifically within the two service which can be both as an extension to your dashboard or as a PDF. We forecast 8 European prices and 27 prices globally, including semi-finished steel, including some semi-finished steel prices. Forecasts are for up to 2 years forward, and they're forecast as monthly figures for at least 6 months forward. We provide outlooks and analysis, supply, demand, capacity, margin data, and I oversee the steel service, but there are a number of other products that cover upstream and downstream markets. So we have coal, iron ore, scrap, pig iron, ferroalloys, tube and pipe, coated steel, and so on. On the right, you can see charted our forecast accuracy for the first quarter forward in Europe, and we think over time we've provided a helpful service to our clients. Now, moving on to the presentation proper, here's the key takeaway from it, which is that European coal product prices will hold below 2023 levels next year, but margins will remain under pressure, and this is because of still weak end user demand and competitive import prices. So let's now unpack this statement. Here you can see our forecast for next year in a complementary webinar. I will provide just a broad overview, this is for hot rolled coal in North Europe on an export basis, and we expect prices to average around 660 euros per ton in 2024. This is below what we've seen in 2023 and in the previous 2 years, but this is still fairly high compared to historical standards. So why do we expect that? There are a number of factors. One is that we expect raw material costs to remain fairly high. What you see here, the purple line is what we call hot metal proxy. This is just a weighted average of coal and iron ore prices to reflect quantities needed to make 1 ton of steel. These are not just spot prices, they are adjusted for lags we see in the market between the spot market and when this fits into a mill production cycle. As you can see, the trend is for a small decline next year, but still fairly high cost compared to pre-COVID, so to speak. The trend is exacerbated if we add gas and power costs on top. Here you see this gray area. This is just the sum of this hot metal proxy and gas and power costs. It's not a linear scenario because for this indicator, we've decided to provide you with a range reflecting different levels of efficiency across mills. The assumption for next year is in this chart is the TTF gas price at 650 euro per megawatt hour. This is a forecast that comes from Fastmarkets microeconomics team, which also forecasts energy prices. It's a couple of months old as a forecast. The market is quite volatile, as you all know, but it is reasonable to assume for next year that prices, while nowhere near the peaks reached in 2022, will still be above levels in before 2021. And this is something to keep in mind, at least in terms of risk management. Now, in this chart, you see this purple area is the same as before, just adjusted for inflation. What I want to show here is that the trend is the same, but it looks much less dramatic once you adjust for inflation. And this inflation is obviously something that we need to keep in mind when we analyze the market going forward. Now, we've discussed costs. Now let's move on to margins. Mill margins have been under pressure in recent months. What you see here, this gray area is a margin proxy, which is simply a difference between hot rolled coal prices and the coal, iron ore, gas, and power costs we discussed earlier. You see there was a jump in this indicator. By the way, this indicator is adjusted for inflation, and overall, what we found is that it's quite effective and predictive in terms of how market behavior reacts to changes to this indicator. And there was a jump in early 2023, which we'll discuss a bit more later. But then in recent months, margins have held at fairly low levels, especially for the least efficient mills. Now, a purple line has appeared in the chart. This is our forecast for margins next year. As you can see, we are not expecting margins at rock bottom, but still we don't expect them to be high. Why do we say that? There are a number of reasons. The two main reasons are that we expect demand to be still weak, and the other is that we expect Europe to have to contend with aggressive import offers. Now, as for the first point, we expect end user demand to improve only slightly in 2024. Now, first of all, short-term indicators are still mostly weak. I cannot spend a lot of time on that because I'm conscious of time overall, but let's have a look at this very quickly. You see the purple bars here. These are German automotive orders. As you can see, they're weak. And the stock of orders in the automotive sector, which had built during the semiconductor shortages, has been evaporating very quickly. If you look at sentiment in the automotive sector, has turned negative in recent months. So, sorry, that was a big jump. If we move on to construction, sentiment has been negative for months. Orders in the German construction sector have improved a bit in recent months, though not great. But if we look at another indicator, such as building permits, that looks very bad. And looking at manufacturing more broadly, orders are still weak. Now, more importantly, if we look at 2024 as a whole, is the outlook, is looking at the outlook for the entire year. What you see charted here are forecasts from Oxford Economics, which is a research firm which we use as a reference for our industrial activity outlooks. And the chart is a bit busy, so let me talk you through it. At the top, you see a gray cloud and a purple dotted line. This is 2014 to 2019. And as you can see, vehicle production has held in the Eurozone at much lower levels in all subsequent years. The forecast for next year is of an improvement, but a modest improvement. Importantly, if we exclude electric vehicles, the forecast is for no growth at all. Now, it is not true that electric vehicles don't use a lot of steel. Steel is the prevailing material used for frames in the sector, but it's undoubtedly there is a trend of lightweighting, especially within electric vehicles, with a bit more aluminum being used in the production of cars. And this is something we obviously need to keep in mind in our analysis. As for the construction sector, demand there is also weak, is also expected to be weak, at least compared to the healthy activity we saw in the recent past. The chart really represents value-added output in the cement, plaster, and masonry industries. Now, these industries don't use flat steel directly, but we found that this data series is much more reflective of the actual hands-on construction activity that drives steel demand in terms of volumes compared to construction as a whole, because we've seen in recent years output in construction being affected by a number of factors that are not particularly relevant in terms of volumes and therefore not particularly relevant for steel makers. Now, automotive construction together makes for close to 70% of coil products demand in the EU, but they're not the only sectors. If we put everything together, you can look here at this black line. This is an indicator that we have built for coil products demand in the Eurozone, which puts together indicators of activity in steel consuming sector on a weighted average basis. And as you can see, the forecast for next year is for a very, very modest improvement, almost no improvement. And in general, is activity is expected to hold at fairly low levels compared to historical standards. Now, the purple bar here are our estimate for apparent consumption in the EU of flat steel. And over time, the two data series have tracked each other quite well. There are exceptions to that. You can see, for example, in 2021, apparent consumption exceeding the indicator, and in 2022 and in late 2022, apparent consumption underperforming the indicator. But there is an explanation for that. Obviously, apparent consumption does factor in stock movements, and those were two moments of significant changes in stocks that do feed into apparent consumption. In fact, if we extrapolate EU flat steel stock movement from the model that we've just seen, and we compare this with actual flat stock movement at German distributors, for which we can get the data from BDS, you can see that, well, the magnitude obviously is different. So the German distributors are a segment of the market. The two track each other extremely well, and this gives us confidence in our analysis. There are a few exceptions to this, one being Q3 this year, which obviously is interesting and important when we look at short-term forecasts. Now, on the issue of stocks, let me also say one thing. A significant upside risk to our forecast is the possibility of a strong restocking. This is because in absolute terms, inventories are fairly low. There may be late in the year possibility of lower interest rates, lower volatility may make the market less risky. But in reality, if you look at stocks as stock to sales ratio, they're not particularly low. Here, the data is through October. Now, the ratio could probably be even a bit higher. So what distributors are really doing is that at best, they're keeping stock to sales in line with historical averages. And as we don't see a big improvement in the end user demand next year, we don't see an incentive for them for a strong restocking. Obviously, this becomes a possibility late in the year as economic activity improves. But for the most part, we don't expect this to be a big driver for 2024 as a whole. Now, another element that we put a lid on prices is going to be a competitive import market. Here you can see our estimate for EU flat steel production. And as you can see in 2023, it was fairly weak. It has been fairly weak. Not only that, you see the black line represents the ratio of production to apparent consumption, and the ratio has been fairly low in 2023. So what does this mean? This means that despite weak demand, domestic producers have suffered pressure from imports. Now, part of this was self-inflicted. As you can see here, prices, well, Julia discussed that extensively. Prices were high in the first part of the year. And the reason for that is that blast furnaces were down. They were idled in the second half of 2022, and they did not restart. You see high prices and weak production. Now, when we had this webinar last year, we said that the market was rebalancing. Prices could only go higher in Q1. But what happened is that the market did not react to that. On one hand, producers continued to keep blast furnaces down well into 2023, and this eventually compounded with unplanned maintenance and accidents. Buyers didn't do anything to give them an incentive to restart. The distributors were very slow to restock, and users were wary of committing to good volumes within contracts. So this complete disconnect between buyers and sellers, inability to adjust to each other, led to a market squeeze, and nobody really benefited because there was no supply to sell in the spot market. So these prices, for the most part, were only on paper, and what they achieved for the most part was to drive a massive wave of imports, like volumes um, that entered from other countries in Europe at the start of October. A lot of that is stuff that was actually shipped in Q3 in response to this wave of high prices. Now, this puts us in front of another upside risk to our forecast, which is the risk of this happening again, a disconnect between supply and demand, with buyers and sellers not adjusting to each other, and just a market squeeze. But we do not think this is the case, because what we've seen in recent weeks and months is a more careful and dynamic adjustment in the market, with distributors restocking a little bit in recent weeks. After mills had idle blast furnaces, we don't see an intention of mills to, at least we already know that some mills plan to restart blast furnaces, so we expect less volatility next year and a more dynamic adjustment, let's say. But this price surge was not the only driver for strong imports this year. As Julia has said, the share of Asian imports into Europe has increased significantly. Now, this was not just to replace lost Russian and Ukrainian imports. So the question is, why was it imports that replaced that and not domestic production? And one factor behind this is this. Now, China does not really export, pretty much does not export to Europe, to the EU at least, but it's the largest flat steel exporter in the world. And because of weak domestic demand this year, it has flooded Asia with cheap flat steel exports, basically. This has left plenty of spare capacity in Asia, and that capacity was redirected toward exporting to Europe at competitive prices. Now, while we do expect some improvements in Chinese demand next year, we don't expect this to lead to a situation where the Asian market is suddenly tight. And because of that, necessarily, save for disconnects between supply and demand, European prices will have to keep narrower differential with Asian benchmarks in 2024. Now, here's a disclaimer, which you will all read carefully. And now we can move on to the Q&A. But before we do that, let me just quickly show you the results of our polls. So the first, well, let's start from the last one. You expect imports from Asia to grow further in 2024? The majority said yes, but it's also it's close to a 50-50, and it makes sense. This will depend on how European prices will adjust to the Asian market. So there is a significant risk in that sense. On one hand, we do expect improvement in the Asian market in terms of economic activity. On the other hand, this does not change the picture dramatically. So yeah, it will depend on how the market will evolve. Julia, do you want to add anything on that?
Yeah, just can comment that no answer I can see where it comes from, because a lot of import buyers, they say that imports is simply not manageable right now because of long lead time and all the risks connected with the safeguards. Because we already saw how fast quotas are filled, and in Q4 buyers were subject to some duty under the safeguards, and that kind of kills the competitive edge for imports. That's why, and also with CBAM phasing in, people are getting nervous or with all this CBAM declarations reporting, and yeah, in general, that also kind of limits interest for import to a certain extent.
Okay. Now moving on to the other poll, let's share results. So here is a bit more clear cut. The majority thinks green steel demand will increase in 2024. Julia, you've been leading on this. You want to comment?
Yeah, sure, of course. In terms of volumes, I'm afraid I cannot really comment because all the information on green steel deals in terms of volumes I'm receiving off the record. But what we tend to see that yes, the demand for green steel or carbon reduced steel, we still need to think of an exact definition, will rise exponentially. It will most likely be driven by legislation, and already now we see in some regions like Nordic countries or Benelux area, if you're in construction industry, if you are building something with a of more 1,000 square meters, you would have to report on the CO2 content per square meter. And of course, that would facilitate buyers to go greener. But once again, we need more regulation from the Commission side. That's kind of under-regulated, and even the very definition of green steel kind of lacks clarity at the moment, but it will come for sure. Yeah, and in terms of questions, I already see quite an interesting one I would like to take, if you don't mind. In cost of liquid steel, one should add the ETS cost as well. What is your view? Well, right now, if we're talking about carbon allowances costs, they vary in Europe between 80 up to 90 euro, with peaks seen in February at 105 euro per ton. But I would like you to note that currently quite a large portion for European mills are covered by free allowances. That will change as soon as CBAM phases in as of 2026. These allocations will be halved by 2030 and fully eliminated by 2034, I mean free allocations. That is why we see that decarbonization drive, among other things, because certainly we can expect that by 2030 the price of carbon allowances under ETS would be 150 euro, maybe even more, and nobody wants to bear that price. And most certainly, it is not very likely that it will be possible to pass that cost to the buyers. So that's why we see that decarbonization drive, and that's why all mills are interested in decarbonizing their operations.
Okay, another question. The second question is, what is your expectation regarding automotive steel consumption in the first half of 2024 versus 2023? On that, yes, pretty much, I said before, the expectation is, basically the expectation for automotive remains overall of growth, steady, but extremely low. So if you look at where we are now in the market, the expectation for the first half of 2024 is not extraordinary. This is the backlog on which a lot of people in the market was counting has not been sufficient to support a surge in activity. And the problem is obviously the cost of living crisis. Higher interest rates feed directly into the cost of buying a car unless somebody pays in cash. So yeah, because of that, the expectation, which we take from outside, I mean, like what you saw earlier was a forecast from Oxford Economics, is the forecast from Oxford Economics is of a slow but steady growth. Now, the next question, I think is
it's to you, I think.
The outlook.
Yeah.
Your assessment for real consumption shows that consumption in 2023 is relatively stable amid a significant gap in apparent consumption. Besides, we don't see respective inventory drop according to BDS. Now, let me, if I can very quickly go back to the chart properly. Yes. So basically, yeah. Once you move on to 2023, you can see, now, first of all, look at historically. The indicator is an indicator that does not necessarily work exactly on a single quarter basis. So the trend, as you can see on the left side of the chart, the trend is the same, but there are variabilities. Now, if you look at, for example, Q2 2023, the indicator and the apparent consumption, they seem to move very similarly. The second half of 2022, this is clearly explained by stock movement. And obviously, if you move into the first half of 2020, the first quarter of 2023, this could just simply reflect lags in how, because obviously, if you look at indicators, cars produced or value-added output, these do not necessarily match exactly the moment in which steel orders come. So basically, I will say up to Q2 2023, from Q2 2023, from Q1 23, I think this is explained quite simply by inventory movement. Q3 2023 is something that I did point out when we come to this. Now, what I would say there is that because part of the indicator is value-added output, so the indicator puts together for automotive is cars produced, not on a seasonally adjusted basis, though, which is also a factor. And for other elements is value-added output, which very broadly is affected by gross margins that can be at times be disconnected. So because of that, this is just a factor. Obviously, as we were in 2023, we will get from the market, especially for Julia, a good sense of where actual demand was. And so if at the time there is a disconnect between a model and the reality, we obviously rework on our model, but we also keep that in mind. And it could what this really tells us is that basically when we look at the short-term outlook is that the model should be, our considerations on the model should factor in the fact that inventories are a bit higher than where the model would want them to be, so to speak.
Mm-hmm.
Now the next question.
If you don't mind, I would like to take the one about
go for it.
green steel.
Yeah,
do you work at Fastmarkets? What is a break-even price for green steel, price that customers are willing to pay? That is a very good question because customers are not willing to pay any premium, especially when the market is so underperforming. But what we can see in terms of actual figures, if we are talking about steel produced in electric arc furnaces by a few producers who can, market their steel as a green steel with carbon emissions below 500 kilograms of CO2 per ton of steel. The premiums would start at 200 euros up to 350 euro for certain Nordic producers. Do we see these premiums being paid in the market? Yes, but mainly by end users, because if you just compare for automaker, for example, the cost of steel in a car is a relatively small portion, but if we speak about distributors or steel service centers, cost of steel is basically almost 100% of their cost. That's why we see the uptake of so-called green steel in Distribution supply chain is relatively low, with mainly big distributors can afford to buy green steel and put it on stock, because for majority of the market it's not really affordable. But once again, we do expect it to change once we see more, I don't want to say regulations, but more like a guidelines from the Commission that would facilitate the buying. I hope that covers your question. Another one, what is your expectations in the EU market after Turkey imposes AD on Russia, China, Japan, and India? And do you see any chance for the EU producers to get possible price increase in the EU market? Well, as we talk, just this morning, we've received an information that one certain leading European producer is already trying to get a higher price for HRC with Q1 lead times, about 30 euro on top of the previous price rise. And once again, all these increases, Paolo mentioned it, I've also mentioned it, the problem with it, that it is not really driven by real steel demand rebound. It is driven by reduced supply and some restocking. But when we say restocking, we also do not see booming volumes. We see buyers being cautious, and we see hand-to-mouth bookings recently, because we all remember bitter lessons of 2022 with stockpiling and depreciating stocks. There is certainly, based on what we hear from the market, there is certainly a room for some upticks for flat steel in a spot market, but there is a lot of uncertainty regarding whether the increase will be sustainable into the end of Q1, beginning of Q2, because of the consumption concerns and availability concerns if we see more capacities coming back online.
So next question, will EU and other countries all over the world put in safeguard or quotas to steel imports because to protect, I guess, their internal production? What do you think? I think Julia has already made a point on in terms of EU safeguards being extended. I totally agree with her. I mean, there's obviously a political risk there, which should be factored in. But our base case, as we forecast, is that all the conditions that the EU stated as the issue when it renewed the tariff rate quota system, which are Section 232 in the US and excess capacity globally, especially in Asia, they're still there. And so, because it looks like the EU has a strong interest in keeping those quotas, it looks like that's the direction we are heading. Now, globally, it is already in the previous question, Turkey imposing duties on China was mentioned. This strong wave of exports from China this year is likely to drive some reactions globally, and not just in the EU, where China is already pretty much locked out. Julia, do you want to add anything on that?
I think that's covered pretty well, and we've already mentioned that. The protectionism is here to stay for sure for quite some time, and we actually have the next question again about steel trade. How do you evaluate possibility of a new anti-dumping duty against Asian and other HRC exporters to the EU in 2024? Actually, I think we've already covered also the similar question last year when we had that webinar, and there was strong expectation that AD will be open against Japan, South Korea, Vietnam, Taiwan. It didn't happen. And right now, some weeks ago, we again heard some rumors circulating in the market that it is possible. like we've inquired the commission about that, and the answer was no comment. So basically, I wouldn't exclude that, to be honest, but I am not in a position to say that I am certain of it, because we do not have neither confirmation nor like denial from the commission on that. Paolo, maybe you would like to add something as well.
No, I mean, I think it covers it pretty well. Now we have one more question, I think.
And I think that would be the last one, because we're already a bit exceeding.
Yeah, we're on time. So on this, very quickly, what is Fastmarkets' expectation on energy prices? As I said earlier, have a macroeconomic team that looks at also at energy prices, and their expectation is that if we look at the EU, energy prices next year will still be fairly high. The gas market is natural gas is possibly the most volatile commodity in the world, so there is that. But the expectation is that they will be high without going anywhere near a squeeze, the squeeze that we saw in 2022. So at the moment, the forecast is the TTF at an average of around 50 euros per megawatt hour. Now, a few days ago, futures were pointing to 40. Today, this morning, they're pointing to 35. The forecast is a couple of months old. I'm not going to speak on behalf of the macroeconomics team if they plan to adjust it. In futures will suggest that we are heading in a direction which was always the possibility. I mean, energy prices were always going to be dependent on the weather this winter at the end of the day, which is still an open question. So yeah, the bottom line is the most likely scenario is that they will be fairly high. Exactly how much it is to be seen. This doesn't fit massively into the cost of a meal. I mean, they're important, but we're not talking between, if gas price was to move from 30 to 50 or vice versa, we're not talking of hundreds of euros feeding into a meal cost. Now there's also a question on freight, and now we do not really officially forecast freight rates. I don't know if, Julia, do you want to make a comment based on what you see on a day-to-day basis?
Well, I cannot say that that's my area of expertise, but again, based on what we see, yeah, freight rates are going up, and I wouldn't exclude them increasing further in the next year as well. So I think we're done. Yeah.
Yeah, I think we passed time. And no more questions. So thank you very much, everybody, for attending. And
yeah, thank you very much. And the recording of our webinar will be available shortly. And yeah, stay tuned with Fastmarkets for more updates. We are looking at doing some online events dedicated to green steel sometime around next year. So if you have any questions, please feel free to reach out to us by mail or via LinkedIn. It was very nice to have so many of you joining us today, and have a great week. Thank you.
Thank you, everybody.